The myth of a neutral money system. We like to believe money is impartial, that it flows without bias, responds only to rules, and rewards effort evenly. That it is a neutral tool, blind to power, blind to influence, blind to intention. But that belief has never matched reality. This matters today because modern money does far more than measure value. It directs behavior. It amplifies some choices while quietly limiting others. And the idea that the system itself is neutral hides how deeply its structure shapes outcomes. To understand this myth, we have to look at how money actually moves. Not in theory, but in practice. Money enters a system through decisions. Who can borrow, under what terms, and at what moment. Those decisions are never evenly distributed. They follow credibility, collateral, and connection. At first, this feels reasonable. Risk must be assessed. Stability must be protected. Not every promise can be treated equally. But over time, these judgments accumulate. Patterns form. Access concentrates. The system begins favoring those already closest to it. This is a reveal beginning to surface. Money does not just reflect the economy. It shapes it. When credit is extended to some and withheld from others, growth follows that path. Opportunity clusters. Risk migrates. Neutrality fades quietly. Institutions reinforce this dynamic without intent. Models rely on historical data. Data reflects past access. Past access shapes future approval. What looks objective is often recursive. The system rewards familiarity, not fairness. Markets amplify the effect. Capital flows where liquidity already exists. Prices rise where money arrives first. Early access becomes advantage. Advantage becomes justification. The system does not announce preference. It embeds it. The early tension forms here. If money is not neutral, then outcomes are not purely earned. They are influenced by structure, by timing, by position inside the system. Yet acknowledging this challenges a deeply held belief that markets are impartial judges. The myth persists because the system works well enough for those inside it. Neutrality feels real when access feels normal. But for those outside, money's bias is unmistakable. The myth of a neutral money system is not maintained by deception. It is maintained by distance. And the farther one stands from access, the clearer the structure becomes. Because money may look neutral from the center, but from the edges, it clearly chooses sides. As the system evolved, its preferences became easier to see. If you knew where to look, money did not move randomly. It followed channels shaped by policy, precedent, and protection. Once established, those channels guided flow long after the original reasons were forgotten. Institutions relied on frameworks designed to manage risk. But those frameworks leaned heavily on familiarity, proven borrowers, established sectors, historical performance. What had worked before was assumed safer than what had not been tried. Neutrality quietly gave way to repetition. Markets reinforced this pattern. Capital chased liquidity. Liquidity followed access. Access clustered around size, reputation, and proximity to decision-makers. The system rewarded those already inside by making movement easier for them than for anyone else. This is where the reveal deepened. Money was not just biased, it was path-dependent. Early advantages compounded. Initial access lowered future barriers. Those without access faced higher costs, stricter terms, and slower growth. Neutral rules produced unequal outcomes because starting points were never equal. The early conflict sharpened here. The system insisted it was fair because it treated similar risks similarly. But similarity was defined by past inclusion. Those outside the system could not demonstrate reliability without first being allowed inside it. Opportunity became gated by history. Behavior adapted accordingly. Participants optimized not just for performance, but for eligibility. They shaped actions to fit models rather than needs. Innovation bent toward what could be financed rather than what could work best. Money guided direction long before results were visible. The myth of neutrality persisted because the system followed its rules precisely. But rules built on legacy advantage do not remain neutral. They preserve structure. They protect incumbency. They quietly choose continuity over disruption. Money did not need intention to take sides. Its design did that automatically. And once design favors certain paths, neutrality becomes impossible. Even if everyone believes it still exists, the conflict reached its emotional peak when moments of stress exposed how selective neutrality really was. Support arrived quickly for some. Others were told to adjust, adapt, or wait. The system responded, but not evenly. Institutions justified these differences as pragmatism. Resources were finite. Stability had to be protected. Assistance flowed where consequences of failure felt largest. But these decisions reinforced the same channels that had already concentrated access. Preference became pattern. Markets reflected this asymmetry with precision. Assets tied to favored channels recovered faster. Liquidity returned unevenly. Confidence clustered. Risk premiums diverged. The system did not collapse, but it revealed who it was designed to save first. This was the heart of the tension. Neutral rules had produced a non-neutral outcome. The system treated risk according to consequence, not principle. And consequence depended on size, connection, and integration. Those factors determined priority. The emotional weight of this moment came from recognition. Money was not just reacting to stress. It was revealing hierarchy. The system's architecture decided who could wait and who had to move, who received patience and who faced pressure. Behavior adapted quickly. Participants sought proximity to protection. Scale became strategy. Alignment became insurance. The goal shifted from competing on value to competing on relevance to the system itself. The buildup was complete. The myth of neutrality could no longer survive direct observation. Money had shown its preference, not through rhetoric, but through action. The question was no longer whether the system was neutral. It was whether neutrality was ever possible in a structure built to manage consequence. And once that question is asked, the system looks very different, because what claims to be impartial often reveals its bias under pressure. The resolution did not come from pretending neutrality could be restored. It came from acknowledging what neutrality had always obscured. Money is not just a medium. It is a mechanism of choice. And choices, once embedded in structure, shape outcomes long after intent fades. The climax arrived with a quiet shift in thinking. Instead of asking whether the system was neutral, the question became whether its biases were understood, monitored, and constrained. Transparency replaced illusion. Awareness replaced assumption. In response, attention turned toward structure rather than rhetoric. How access was granted, how risk was evaluated, how support was prioritized during stress. The system began confronting its own design rather than defending a myth that no longer held. The resolution reshaped responsibility. If money could not be neutral, it had to be accountable. Decisions that shaped flow were treated as consequential, not automatic. Power was acknowledged instead of denied. And once acknowledged, it could be debated rather than hidden. What endured was a defining insight. Neutrality is comforting because it removes agency. But systems that deny their own influence cannot correct it. Money does not need to be impartial to be functional, but it must be understood to be governed wisely. The myth of a neutral money system was never harmless. It delayed recognition. And delayed recognition delays reform. Because only when bias is visible can it be managed. And only when it is managed can trust exist without illusion. Sometimes the smallest shift in perspective becomes the beginning of a new future. The myth